Well, welcome to Money with Mark Albert, and particularly now on this Smart Money Question series, where we address smart questions to guide your estate tax and legacy plans. I'm the host, Mark Albert. Today is question number two. So, question number two is how do we determine how much life insurance protection I need? And why is term life insurance, whole life insurance, or universal life insurance the right vehicle for my timeline? So basically, determining your life insurance protection starts by separating your financial responsibilities into two distinct categories. So we're going to look at how to do it and how to understand that I have the right protection and what type of life insurance product I should be in. So the two categories, you have your temporary needs versus your permanent liabilities. Rather than using a generic rule of thumb or a generic math equation, we apply a clear calculation model to both categories of temporary needs and permanent liability. And we basically align the result of those two within the correct policy vehicle. So I'm going to explain this further. So we've got the math is you've got your temporary needs, you got to calculate that, and that's basically income replacement and debt obligation. So when I do income replacement, so for example, if I am an employee, I have a salary, so the gross total income before taxes is removed is the math I use. So it will be my income for the year multiplied times, I like to use 10 because if you receive a tax-free lump sum of 10 times that amount, it's very easy to take care of a person from an income because basically you're replacing that income. So in the the worst time in one's life when the loved one passes away, they're grieving, but at the same time, to experience financial devastation would compound that situation, make it even worse. And then any debt obligations I would tack on there. You could put, some people like to put like their educational needs for their kids, if their kids are still in need. So you could put that, that'd be temporary. You could project the cost to them go to university or something like that if you haven't already saved. Also, if you are going to need some assistance, take care of the kids, that'd be a temporary need. You could put that in there, a little bit extra stuff for childcare. And there are several things you could put in there too, but the two big categories would be income replacement and debt obligation. Now, the one thing I do, so let's say one of the spouses is home with the kids, they're not earning an income. So from an income replacement standpoint, there's no math, but there's a value that's placed on the life of the individual caring for the child. So there's a real true value that needs to be attached to that person who's home with the kids. All right. So that's temporary. So permanent need calculation, that's dealing with stuff to do with taxes on death and estate preservation. So I'll explain that. So taxes on death. So when we die, sometimes there's things like a cottage or some investments that are non-registered investments or a rental property. When you pass away, it triggers what they call a deemed disposition. So you're basically, those things are taxed as if it was sold, even though it's not sold at that point in time. And so it can be pretty significant. Capital gains can be a very significant impact on the estate. Another area of tax that I see a lot is taxation on income. And a lot of them is people who have saved a tremendous amount of RRSPs, or they have a lot of RIFs for retirement, and um, and that's taxed as if it was income at death, unless you have the named beneficiary who's your spouse or common law partner. So if you have your kids as named beneficiary, the kids will get that tax free, but the estate will get taxed as if it was income to the estate. So we talk about estate preservation. Uh, we're talking about all of the things you've owned, your net worth, the total value of who you are, preserving that for the next generation. So another thing you could put in this slide is there's other costs associated with settling an estate. So if you're an executor, I'm going to go to this next slide here. So if you're an executor, you'll notice here that these are the type of costs that the executor has a responsibility to deal with. Now, obviously, the one here, executor compensation, that is that is one that not everyone has. So oftentimes, if you're a named beneficiary of the estate, it doesn't make sense to be compensated because the estate pays you, and then that's taxable income. So you'll have to file that on your tax return. Whereas any money or resources you get from the estate is tax free. So I wouldn't bother with that. And here's some other potential costs in selling an estate that you may see there. And you may be surprised if someone has a few rental properties, you know, or a house that can't sell, just to maintain that property, the obligation could be pretty significant over time. So there should be resources for that. So let's talk about the life insurance types, right? So you've got basically term life insurance, which is for a term or period of time. It deals with kind of the shorter term needs, especially when there's responsibility. You have kids, you have a mortgage, your spouse depends on your income, your family depends on your income. And so it provides term life insurance. I do really favor this, as it provides high coverage at the lowest initial cost. Um, and it's really good for dealing with the short-term scenario. Um, and because it's the lowest cost, you see the permanent insurance, which we're going to look at, it's a much higher cost. And they measure life insurance like a cost per thousand. So it's like when you buy gas, you pay a cost per liter of gas, which is 1,000 units. So they have a cost, a dollar something a unit, or per liter, which is 1,000 units. So buying term is like that. So it's a cost per $1,000 of protection. So there's something called buy term and invest the difference. What that means is you're basically buying life insurance at a very, very low cost. You maximize the amount of protection, so you have the right amount of protection. And then the difference you save compared to buying the same amount with permanent insurance, you invest that. And so the concept there is that by the time you're in the later years where you have less responsibility and obligation, you are self-insured. So you don't need life insurance. It's just a matter of restructuring your assets so that you deal with your estate and proper taxation of resources going to your state and so on. So that's a good one that works. The problem there is sometimes people they're not effective at saving the difference. And then they have difficulty funding the estate and taking care of things at the end. Now, permanent insurance, there's two types. There's whole life and there's universal life. Now, both of those will go till 100 years old. Both of those will deal with final expenses for you. The whole life and permanent, they both provide permanent, lifelong protection. They both have a fixed premium, and they both have savings built in. They called cash value or cash surrender value or guaranteed cash value. And they use different terms, different insurance companies do. So it's ideal for funding your permanent tax bill at death. And you could also guarantee inheritance at death as well. Now, the universal life, I don't like that one very much at all. And I don't sell that one to anybody. I don't offer that. You got two types, and I can talk more offline about why I don't like it, but you've got these level cost insurance, which if you're going to go with universal life, that's the one I would go with. Then you have another one, it's called the yearly renewable term. That one's terrible because the cost of your insurance starts low in the early years and then it increases as age goes on. So in the early years, you may build up the savings within the policy more, but in the later years, what happens is the cost for life insurance protection, it's yearly renewable term. So every year the cost for the life insurance portion goes up based on the risk the insurance company takes because you're getting older. When we get older, there's a higher probability of dying. And so what happens is that particular one, the yearly renewable term, it can implode from within in the later years. And so I've seen this so many times where insurance companies will send a letter to the client saying, "Oh, you have to give us extra money. You have to send us more money to fund the policy. Otherwise, we're going to have to cancel it because it's going to implode from within. It's going to run out of resource." Because I won't talk about this one much more, but just know that's not my preferred one. So bottom line is we never pick a coverage amount or a policy type in isolation. We calculate the precise dollar value of your short-term responsibilities versus your permanent estate obligations, ensuring you buy the exact amount of coverage required and match the policy timeline to the lifespan of that future burden. So there's a burden now if I die, which is going to be different than the burden in the later years if I die. So think that through with a qualified life insurance professional. If you need any assistance, my contact information's here. And I trust that you are well and that you are having a successful life. And we do appreciate you being with me here on my channel. Take care. Have a great day.